In this video, we're going to change gears just a little. Previous videos, we were talking about the concept of a perfect capital market. One of the things associated with that was that there was a world without taxes. So in this series of videos, we're going to talk about the impact of taxation and expenses like that on the value of the firm. So these things all affect, in this case, it's debt. How do debt and taxes interact? And how does that influence the value of the firm? If you remember, in a world without taxes, V sub L equals V sub U. There's no change in value of the firm. So let's start this with a little bit of a story to see how this logically plays out, right? Again, we have a company that wants to pay you $100. The company pays taxes, but you do not. So do you care, as an investor, do you care whether they call it $100 of dividends or $100 worth of interest? And of course, since you pay no taxes, you don't care. But the corporation does care, because when they pay dividends, there's no tax benefit to them. They don't get to expense the taxes. So they would rather pay interest, that $100 as interest, rather than dividends because of the tax benefit. So in these series of videos, we want to attempt to explain how that works and why that works. Again, corporations pay taxes on their profits, obviously. So interest expense reduces the amount of corporate tax. So this creates an incentive then to use debt, because essentially the government is sort of subsidizing debt. If they allow you to reduce your profits by that expense, that means they're covering that, because now you're not paying profit or not paying taxes on that portion of profit. So here we have a company. They have about 2.8 million in 2014. Interest expenses are about 400 million. Marginal tax rate's 35%. So again, the net income of 2014 was lower with leverage than it would have been without leverage. So without leverage, right, we would have made 1820, right? So they would actually, if they didn't have any debt, they obviously would have had a higher level of net income. But now let's see how this all works, right? Macy's debt obligations reduce the value of its equity, but the total amount available to all investors was higher with leverage. So without leverage, there's no debt holders, then the shareholders get the 1820. But if you have leverage, $400 is going to go to the debt holders, $1,560 goes to the equity holders, which now means that the total available to all investors is now $1,960. So they could pay everything out to their owners as $1,820, but with leverage, they could actually pay again $1,960. Where does that additional $140 million come from? So we need to understand something about this thing called the tax shield. It's a reduction in taxes paid due to tax deductibility. It's just the corporate tax rate times the interest payments. So in Macy's case, 980 million minus the 840 is 140 million. That's what we're trying to find. So the interest payments provided, 35% is the marginal tax times the 400 million. That's 140 million. That's where the extra $140 million comes from. It is a tax flow to the company for being able to deduct the taxes away from the taxes that they pay. So when a firm uses debt, this interest yield provides a benefit. It's the present value of the future interest. So the cash flows a levered firm pays to investors is going to be higher than they would pay without leverage, right? Cash flows are higher. Why is that? Is because the interest tax yield is a cash flow, right? You used to have to pay taxes, but now that money comes back to you, and you now no longer have to pay that cash out. So how this ultimately works in formula form, the value of a levered company, the L and U here should be in a lower script, but the value of a levered company is the value of an unlevered company plus this present value of the interest tax yield. So for every dollar that's borrowed and you pay interest on, you get a boost in value. So typically, interest payments change because margin tax rate changes, debt changes, interest rate could change, right? The risk of the company could change. In these examples that we're talking about, we're going to assume that all of those things stay fixed. So how do we find out this present value of the interest tax yield? If you borrow debt D, right, and you keep that debt permanently, right, then marginal tax rate is T sub C. If we say that the debt is at the risk-free rate, then the interest tax yield is T, corporate tax rate, times the return on debt, the interest, times the amount of debt. If you plug that into a formula, if we assume that this is a perpetuity, right, it's permanent, T sub C times interest, that's the tax yield. Now we have to divide that by the risk-free rate. That makes it an annuity, right, or a perpetuity, excuse me. If you expand that, you see that the risk-free divides out, so we end up with the present value of the tax yield is the corporate tax rate times D. So for every dollar that you borrow, that increases the value of the firm by T sub C. So again, the market value of debt is the present value of the interest payments. So again, this as long as this marginal tax rate is constant, then in the end, T sub C times D. This is the present value of the tax shield. Again, we're going to talk about this in more videos. It's still coming. See you in the next video.